by announcing this material will not be examinable, I am deliberately minimizing your interest, but doesn't mean that you can't fall asleep or anything like that, okay? Now, so what we're trying to do today is we looked at how we outlined how people ought to make choices if there's risk and uncertainty. In other words, we looked at the expected utility as the correct way of analyzing a person's decision when he or she faces uncertainty in the future. The thing is, as I said, that uncertainty underlies the people's desire to move money from this contingency to that contingency, this state of nature to that state of nature, underlies what we do as finance people. Finance is about pricing consumption on the different states of nature, really. That's why we invest in stocks, we put money as savings in bank accounts, etc., etc. We save, we borrow, we buy houses and make payments on it. So that's why, after choice and uncertainty, it's natural to lead into risky assets. So I've written down chapter 13 is examinable, but I've cut it. Okay, today's material will be not examined. Okay. So suppose that an individual's preference, so your preference, can be captured just by looking at two key statistics about the probability distribution of your final wealth. Okay? That being, first, mean, and B, variance, mean variance optimizing. In other words, you like to have more wealth. That's good for your utility. Okay? But what's bad is it's risk, variance. So the higher the mean, the greater the satisfaction you have. Suppose that W denotes your wealth on the state S, I don't know, if you win a lottery or if your stock market do well or if you invest in a particular stock, then obviously it's a probability weighted average is your mean. Variance, on the other hand, is your wealth deviation away from the average squared. We all know that, I guess. Obviously, its positive square root is the standard deviation of it. Okay? Now, mean variance utility assumes that an individual's preferences, your preference, everyone's preference can be expressed in the form of mean and variance, obviously. Then we add risk aversion. You like mean, so for a given portfolio with same variance, the higher the mean, the more you like, obviously. Portfolio with same mean-wise, the lower the variance, the more you prefer, the higher utility you have. Then, suppose that you can invest in two different ways. So this is suddenly becoming a sort of revision session for your financial management lecture, somewhat, or investment lecture, but let's follow on. Suppose there's a risky asset and a riskless asset. That should, by the way, read riskless, not risky, okay? So riskless asset always pays rate of return RF. Risky asset, however, pays expected return of Rm and variance of sigma m squared. This is a sort of standard setup you see in finance, okay? So you can think of that risky asset like a mutual fund or investing in some sort of like stock index, like ETF. What's an ETF? So that's a passively managed fund where if the stock market index goes up, that mutual fund mimic the stock market portfolio, so your return goes up. Okay, so suppose that this risky asset pays return amount of ms in state S with probability pi s. So there can be different states of nature, you know. So think of it like Bank of Korea raising interest rate, Bank of Korea holding interest rate constant, Bank of Korea lowering its interest rate, I don't know, or whatever. Or election-wise, 새누리당 wins an election, 더불어민주당 wins an election, no one gets an outright majority, or whatever. Different state of nature, okay? So suppose that you have to divide your portfolio into two. Suppose that you put X times 100% in risky asset, and 1 minus X times 100% in the risk-free, riskless asset. So this will be, for example, 0.4, 0.6, or something like that. So what will your expected return on your portfolio look like? Well, what you have to do is add up across the S different state of nature. You've got to look at each state of nature and then weight each state of nature according to, finish the sentence please, its own probability of happening. Okay? So what do you get in state S? Well, you get, say in state 1, you get X times M1. That's state 1. Plus 1 minus X times RF. But this has to be weighted by the probability of state 1 occurring. And then you add up pi 1, pi 2 plus X plus M2, 1 minus X times RF, etc., etc. Then you get this summation operation, in other words. What that means is your portfolio return, you invested X% in risky asset. So you're going to get the return on that. The rest you invested in risk-free, something like bond, a bank, whatever. Okay? So you get that. But that state of nature will occur with probability something, 20%, 30%. 새누리당 wins the election with, say, probability 50%, 더불어민주당 with 30%, whatever. So add up across the state of nature, then what do you get? You get, regardless of, because all this is being added up. So you can do this. What you can do is pi s, that's the return you get on the risky end of the things. Yep, pi s can be taken out. But no, it cannot be taken out, sorry. That plus 1 minus XRF is always certain, always constant. So that can be taken out of the summation. But this is a probability, so if you add up probability across entire state of nature, what are you going to get? 1. So that's done. This is your ms pi s, but x can be taken out. So this is what? Your expected return. So that's Rm. So you get that under the final equation without too much difficulty, obviously. But what about your portfolio variance? Okay? So knowing that your Rx, expected return, is given like that, you have to look at each state and look at this, each state's wealth minus its expected value, overall expected value, and its squared deviation. Then weighted according to the probability. Okay? But that means essentially that at each state you get your expected value. Okay? Cancel that out. Then you obviously get something like this, xms minus xrm squared. So if you calculate that, you're going to get this. What should we do first? 계량금융 하시는 학생들한테는 특히나 베리언스 때문에 어차피 복습하는 차원에서라도 what should we do first? Expand out everything. Yep? Then we're going to get x squared ms squared. Pi s is just going to be taken out entirely. Okay? Now, sorry. Pi s will not be taken out entirely yet, but pi s, okay, you can go to here. Right, minus 2, then what? Plus but what happens to this if you add up across the state of nature? Rm can be taken out, 2 as well. So it's going to be, and then x squared as well. X squared, s minus 1, s ms. That's Rm again. Huh? Of course, pi s ms. But what does this equal? Rm. So that's Rm squared, x squared. Here as well, if you take x squared and out, then you get 2 minus 2 Rm squared x squared plus Rm squared x squared. So if you cancel it out, then you're going to get minus 1. Then if you put that back into the summation operator, then you end up with that. Okay? Knowing this is helpful. Not knowing this is not the end of the world. Okay? I mean, that's just deriving the variance, I guess. So why is this useful? Well, once you've got this far, you can take x2, x squared out of it, and the rest, whatever you have within the summation operator, this, in other words, pi s ms minus rm squared. That's your definition of variance. Okay? So, all I wanted to derive was this. I've gone through that entire trouble. 계속 그렇게 서메이션 뭐 떼고 찍고 했던 이유가 결국 요거 때문에요. What's your portfolio variance? It's how much you invest in the risky asset squared times the variance of that risky asset. So your standard deviation of that is if you take the square root of it, it's just that, obviously. Now, generally what you have to assume, however, is that Rm must be bigger than Rf. You know, that makes sense. If there's a risk-free asset that gives you larger amount of money that in expectation, for sure, than the risky asset, then who's going to invest in risky asset? Obviously. Yeah? 아니, 위험이 없는 자산이 위험 있는 자산보다 더 돈을 많이 주면 누가 미쳤다고 위험 있는 자산에 투자를 하겠습니까? 그죠? Therefore, the expected return on the risky asset must be higher. Rm must be generally greater than Rf. What that means is this. In order to attain higher return, you have to accept some risk, higher risk, obviously. So it's like this. What your portfolio or what you have in front of you is offering you on the market, you have risk-free asset, and you can combine it with risky asset with higher return but higher variance. Okay? Now, if you plot expected return at y-axis, standard deviation at x-axis, then you're going to have this straightforward relationship where if you put more money into the risky asset, your expected return goes up, but your standard deviation also goes up. Because your portfolio return, let me write down once again, is this. Yep. And your standard deviation is also given by that. So you're trading off. The more money you put into risky asset, in other words, increase X, what do you get? You get higher expected return because you put larger weight on this, smaller weight on that, and that is larger. But this is also the problem. You have to accept higher standard deviation in return. Increasing small amount of X, if you sort of like differentiate if you like, you get RM minus RF, excess return on top of risk-free return. But that has to be traded off against higher risk. Okay? So that's the sort of rate at which you're willing, the market is willing to allow you to trade off between return and risk. 이게 지금 투자론에서 다 듣는 얘기일 겁니다. 경제학적으로 백그라운드가 있지만. So that's your budget line, if you like. Given that you have a risk-free asset and risky asset, this is your attainable choice. That's what the market, the financial market, is allowing you to have. You can have absolutely no risk at RF, or you can have return as much as RM if you accept risk, in other words, standard deviation, as much as sigma m. So the rate at which you trade, that's the rate at which you trade return-risk trade-off conditions. And also, this is very much like Sharpe ratio, right? Yeah? The excess return you get per unit of risk. But now you can see that the Sharpe ratio is essentially the rate that market is willing to offer you in terms of like a budget constraint. Given that budget constraint, what you have to find is where you want to lie on your indifference curve. Now, your indifference curve doesn't shape like this, but it's shaped up because risk is not a good, it is a bad. 효용을 주는 재화가 아니라 비재화, 역재화인 거죠. 리스크는 싫은 거죠. So for the same return, same expected return, the higher risk you have, the lower your utility. If you move towards the northwest of it, move from here towards there, you increase your utility. Yeah? And that's why the highest indifference curve, in other words, the indifference curve that gives you the greatest amount of utility or satisfaction is there. Now, you can't do anything about what the market is willing to offer you. Yeah? Sharpe ratio, if you like, is fixed. What you can do is, given your preferences, some people are less risk averse. Some people will accept more risk more easily. Some people will hate risk a lot. So even if everyone has sort of mean variance preference, some people will put a lot more weight on that variance. Some people, more aggressive ones, will put very little amount on that variance. Okay? What I'm saying is the market budget line is something you by yourself cannot alter. It's your constraint. The market's rate of trade-off, that index trade-off, is something you can't do anything about. On this budget line, where you choose to be on that budget line is up to you. That's where you do. You optimize according to your preferences. What you can alter is where you want to lie on this budget line. 저 버젯 라인이 주어졌을 때 내가 어디에 있을 것인가는 당신의 프레퍼런스에 달린 문제라는 얘기입니다. 그렇지만 그 프레퍼런스 말고 어쩌지 못하는 것은 그 제약 자체예요. 마켓이 주어진. 리스키 아셋은 이만큼 줄 것이고 리스크 레스 아셋은 이만큼 줄 거다라는 그 제약은 주어진 거예요. 그 제약선 위에 어디에 있을 거냐, 나의 예산선 위에 어디에 있을 거냐가 내 프레퍼런스를 따라서 결정해야 될 문제라는 거죠. However, even if you're incredibly risk averse, you will not generally consume at a corner slit. There will be an interior solution somewhere. You're going to be very close to here, but it can be shown very mathematically that even those who are highly risk averse will prefer to put at least little amount of money until their own marginal rate of substitution between return and risk is equated to that slope there. 이거 되게 중요한 얘기예요, 방금. On finance-related perspective, that is incredibly important. Risk-return trade-off. The fact that people are risk-averse doesn't mean that they're not going to invest in risky asset. 사람이 위험을 회피한다, 내가 위험을 싫어한다라고 해서 그게 위험 자산에 투자하지 않는다와는 연결되지 않는 얘기예요. 요거 이해됩니까? Even if people are risk averse, they will still invest some amount into risky asset. People who are highly averse will put less weight in the risky asset. But chances are most of the time there will be an interior solution, and that interior solution will be greater than x equals 0. At that corner point, you can't get a tangency. 탄젠트 할 수가 없잖아요, 코너 포인트에서는. 그 얘기는 뭐냐? 요 근처 어디쯤 가서라도 아무튼 옵티마이징하는 포인트는 뭐 요렇게 됐던 간에 여기 어딘가에 있을 거라는 얘기죠. 즉 x가 0이지는 않을 거다라는 말. Even for mean variance optimizing risk averse people, they will in equilibrium at the optimizing point put some amount in the risk asset because they higher return. Even if they hate risk, they will accept up to some degree of risk where their own rate of trade-off between return and risk is equated to the slope of the market, security market line, SML, the rate at which the market is willing to trade off risk and return. That was the point, that sort of going back to the revision end of things. That was the principle, that your own rate of return, so rate of substitution between two goods, MRS, is equated to the market rate of substitution between two goods, relative price. We have that relative price. we have that relative price in terms of return over risk. That market return over risk, that Sharpe ratio, if you like, will be equated to each and every one of your own rate of substitution in equilibrium. That will be your optimizing point. And at that optimizing point, you will invest some positive amount in the risky asset. So it's a philosophical finding. Even when people are risk averse, they will invest up to the point where they prefer return to risk. Their own optimal risk-return trade-off is equated to the market's own return-risk trade-off. That's what I've written down. So the consumer equates her marginal rate of substitution to the price of risk. That's true for any consumer in equilibrium, regardless of how risk-averse you are. Raphael might be incredibly aggressive. He might be very not risk-averse at all. Melissa might be incredibly risk-averse, one of those people who revises everything because, you know, she doesn't know what's going to come up in the exam type of people. But in equilibrium, all of your MRS, all of your own rate of substitution will be equated to that market rate of return between, market's own substitution between return and risk. That's an important finding. And obviously, when the consumer is offered a new fund with higher slope, okay, notice that she's going to move up to that new fund. You're not going to mix and match two different funds and create something. You're not going to consume somewhere near here. You're going to move completely to the new fund with higher slope. What does that mean? You're only going to use, assuming it's a well-diversified fund, obviously, the fund with highest Sharpe ratio. In other words, the best price of risk, the best return-risk trade-off. A fund can be fairly safe and low risk, or another fund can be very high return, high risk. It doesn't matter. What matters is, assuming short selling is allowed, don't oversee that, but what really matters is this: the fact that the fund you use offer best, the most preferable trade-off in terms of return and risk. You're only going to use that. If you go into asset pricing a little further, that's going to be summarized in something called the mutual fund theorem. Okay? Generally, it relies on a lot more assumptions and stuff, but it's a philosophical finding. All you will do is you try and find the fund with the highest Sharpe ratio. Then the rest is your job. You will put money accordingly. You will vary your own weight in that asset and find your own new optimizing point. But if a fund offers better return-risk trade-off, you should take it. Then the rest is your own job, your own optimization through your own portfolio rebalancing. Now, so that was the case of one risky asset and one risk-free asset. But obviously, what if there are many assets? Then obviously, the mean and variance of each asset doesn't matter that much. What matters is how they are interrelated with each other. See? The value of the asset then will depend on how it is correlated to other markets. So this is where the concept of beta in CAPM comes in. But what that beta roughly says is how risky the overall market is on the denominator, and how risky that asset is relative to the market as a whole. So in other words, the meaning of beta is like this. When the market moves like this, will your asset move with the market and be more volatile like that? Or when a market may move like that, but your asset may be a lot less volatile? The first case is high beta stock. The second is low beta stock, the stuff that we really like. So on average, what I mean by beta here is beta equal 1 means over a long history of time, on average, when a market goes up by 1%, when a market fluctuates by 1%, it's going to move with the market exactly 1%, 1%. It doesn't mean that on any given particular day, its return will be the same as the market. On average is the important part here. But the beta means, on average, generally, over a longer period of time, if you take average of it, it's going to move with the market and roughly fluctuate as much as the market. An asset with beta 2 or 3 or 4, generally in US market, some stocks have beta up to about 5.8, 6 point something. That means those assets will fluctuate by about 5 or 6 times higher than the market. If a market goes up by 1%, on average, it will go up by 6%. If the market goes down by 1%, it's going to go down by 5, 6%. I'm not saying on any one given day, on average, over a horizon. So those type of assets are more volatile. It's much more volatile, risky. It's very sensitive to stock market. Okay? But once we have this concept of beta, then we can talk about an equilibrium from economic perspective. CAPM, most of you will have seen and learned about in your second year, third year, whatever. But what I'm trying to show you is that CAPM derives from the consumer's own optimizing decision. Okay? Now, no arbitrage condition implied that every asset had to yield the same level of return in the absence of any uncertainty. So now we have to adjust for risk. Think of our risky asset in the earlier example. So we had one risk-free asset and one risky asset. Now think about risky asset as the mutual fund containing all risky assets, like stock market index. Okay? You can do that due to something called that mutual fund theorem you're going to learn in your later on in your year, third or fourth year. Then we can refer to that risky asset as something called a market portfolio, like KOSPI, like S&P 500, like FTSE 250, Nikkei 225. Okay? It will also have its own expected return RM and standard deviation of sigma m. So that risky asset, that market portfolio's price of risk is RM minus RF over sigma m. But it doesn't tell you about the price of risk of any given individual asset, because it's only the portfolio that you know. What I'm saying here in equilibrium is that the total risk of asset I is the market risk sigma m multiplied by its beta I. In other words, beta I times sigma m tells you how risky that asset is in terms of risk adjustment. Why? When the market is risky, you're more risky. But second, if your asset is exposed to the market movement a lot more than other assets, you're also more risky. So it comes in from two things. A, either market as overall may be risky, or B, market might be moving a little at the moment, but your asset is particularly exposed to the market movements. So you have to multiply that by this. That's called the risk adjustment factor. So if you do that, you're going to get this. And for any two assets, no arbitrage condition requires that the risk-adjusted return should equal each other. In other words, it doesn't mean that any two assets should have two same return. Now, what you're claiming is any two assets due to arbitrage must have same risk-adjusted 위험 조정 수익률이 같아야 된다는 얘기죠. We've had this. We know about this. So asset I and asset J must have return on asset I must be adjusted by something. That something is given by beta I times sigma m times the price of risk. That's the price of risk, the rate at which return and risk is being traded on the market. But you have to have the risk adjustment factor. It has to be multiplied by how sensitive the market is and how your asset is incredibly additionally sensitive relative to that market. That's why beta I times sigma m. Cancel that out. You get this times that. So Ri has to be adjusted by this much. In other words, what does this mean? If your asset is more exposed to the market, and more sensitive to market movement, beta I will be high. Then, to provide same amount of return as another asset, because beta I is higher and because you're subtracting something bigger, what should this be? Higher. The more exposed to the market risk that particular asset is, the higher return it must promise. Otherwise, people are just not going to buy it. 사람들이 그 아셋을 사기 위해서는 RI가 자연스럽게 높아져야 된다는 얘기입니다. 어떻게? 가격이 떨어져야겠죠. But crucially, that relationship must also hold if you compare RI, any asset, with an asset with beta 0. In other words, risk-free asset. Something that doesn't move with the market. So if you rearrange that, there's your CAP-M. There's your CAP-M. By the way, a lot of people know this as CAPM, but it's pronounced CAP-M. Okay? CAP-M is saying an asset, a particular asset, 삼성전자, or P&G, or 3M, or whatever, that asset return should be higher than the risk-free return. It must promise higher return than the risk-free asset if it is more exposed to the market movements. In other words, it has higher beta. That beta is the single most important factor that prices every asset. Each asset will have its own correlation, its own sensitivity to market movement. What CAPM is telling us is that because of how people make return risk trade-off decision, that beta is the only thing that's going to matter to asset pricing. The more you are exposed to market risk, clearly the higher that asset return is. That's the important part. So you will have all seen CAPM from a sort of finance perspective. I respect that. There's nothing wrong with it. And deriving CAPM sort of implicitly assumes you optimize through this sort of process. But why I have revisited this within the context of microeconomics is the fact that pricing of those financial assets is just like decision-making and choice under uncertainty. People's desire to optimize under uncertainty gives rise to that CAPM. Assuming people are mean variance optimizers, so you're restricting the utility function. Mean and variance is everything that people care about. Then risk is just like any other good. There's a price for it. And that correct price is given by that CAPM. People's own rate of substitution being equated to the market rate of substitution, and people's no arbitrage condition between two assets colliding together, that's enough to give us the CAPM result. So where that beta comes in, I mean, everyone, if you go into, I don't know, an interview at a finance firm somewhere, people are going to say, what's the meaning of the beta? That meaning of the beta is, obviously, an asset's correct way to price an asset is look at how it's sensitive relative to the overall market. Yes, that's good. That's what you have learned in finance. But what I'm trying to give you is the perspective on why. Why that beta I matters. Why that beta is the only correct way. Why that sensitivity relative to the overall market is the key. That's because people optimize over risk and return trade-off. And that beta is the correct way to price risk. So I said that throughout this lecture, the important results we're going to see will all arrive as a byproduct of people's own optimizing process. CAPM is just one of it. Choice under uncertainty, how people price risk relative to promised return. That optimizing process is what we get as CAPM. That's the product of it. That's the end product of it. That's why economics and finance are sort of interrelated. The key asset pricing principles that we see in finance are ultimately about people's optimization.